Yeah.
There's four big moving parts that I think people have to focus on within this report, right? So real GDP is up at around 2.9%. You have to look at a couple of very simple metrics to understand just how bad the consumer side of this is. Okay, so first off, you see inventory investment. Inventory investment is basically companies building out, right? They're buying stuff ahead of time, and now it's going to sit in inventory for a period of time. That's not good. Intel just had a horrible earnings report, effectively warning we've got this massive glut. The second thing is look to the far right. Housing has collapsed, absolutely collapsed. And I'm going to explain why that's important in a second. Third, consumer spending is still being driven by negative real interest rates. And that means the CPI is less or is higher than the Fed funds rate. Those are negative rates for an economy. It forces consumers to spend. Then here's another important component. Louis Navellier in the beginning of the fourth quarter was looking at the fact that GDP was up maybe 2.7%. He noted that virtually all of the GDP growth came from the U.S. government's sale of oil from the Strategic Petroleum Reserve. Those sales are in that number. And we did not start to cut that plan until December. So we were still selling a lot of oil in October and November. If you look at the non-core items, you get rid of the government spending, you get rid of the exports, you get rid of the inventory build, the core GDP was about 0.6%. That's not good. And EPB Research has noted, this is a really great observation. It's a young guy who's up in New York, and he noted that recessions are primarily driven by three things. One, durable goods purchases. Two, weak housing investment. And three, weak business equipment investment. The first two, drop in durable goods, drop in weak housing, that's already in that chart. The business investment is going to come in this quarter because we've already built the inventory. And if you go back and you look at those three things, we were down 3.2% for the quarter. And if you only focus on housing and durable goods, which EPB rightfully argues is what drives an economy in and out of a recession, those two things combined were down 5.5% for the quarter. That is a decimation of aggregate demand, and that is very concerning about the consumer moving forward.
So, yeah, that is, well, and let's not forget the amount of debt that the consumer has built up to actually do all that spending. At some point, that's going to get way too stretched. We haven't even heard a story about a foreclosure yet. Those are going to start happening. Although the banks were a little smarter at the time when they were loaning money, I will say that.
Well, prime lending is very, very good. It's the companies that are in the subprime world that are eventually going to run into a wall. And, we've seen some rallying by the companies like Ally and LendingTree. And these are companies that rally when momentum is positive. They're short squeeze candidates. And you just you buy them, you bid them up, you get out of the way, but they're likely going to see some problems on the backside of this year.
Yeah. So, what are you doing to, knowing that you see these big macroeconomic shifts? What are you doing about it?
Well, again, the only thing that you can do is when you learn about trading and you learn about momentum in these markets, the only thing you can do is keep dancing while the music's playing. Eventually, the music's going to stop for a little while. So we've been buying the stocks or trading the stocks that do the best in positive momentum conditions. We're selling put spreads on those in Flashpoint Trader, and then we're launching Hyper Momentum Trader next week. And if the market turns back around and we do get the connection between the underlying economy and reality once again, and the capital flows in and out of this market, we will be targeting those really ugly companies with high priced sales numbers, high short interest, just terrible balance sheets, and then we're going to look to use their elevated prices and move lower. Stop it.